Welcome to Beat the Markets.
I'm Ritger.
And I'm VKM. So Ritger, can we beat the markets?
I think we can. And I think others can too.
So, is it possible? Is it possible to beat the markets?
But what does beating the markets mean?
It's a good question.
Does it mean a higher annual return? Does it mean lower volatility? Does it mean meeting your own personal objectives? Different things means different things to different people.
So it's a big question. Let's narrow it down a little bit. I think most people, when they approach the markets, what they really want to do is make some money. Bottom line. And you know, when I was coming up in the late '90s, there were two books. There was A Random Walk Down Wall Street by Burton Malkiel, which was kind of I think one of the first books about it's hard to beat the markets and a monkey throwing darts at a stock table could beat the markets. And then there was Market Wizards. And as a young person, you clearly know which side what you wanted to believe in. You wanted to believe that you could read Market Wizards and beat the markets and make some money. So if I would ask me, if you asked me when I was very young, do I think you could beat the markets? I would say, yeah, of course. I was in a room full of traders and we were all beating the markets. Fast forward to 21 years later, and I have a much more refined view on that. I think it's a lot more difficult, and my views on that are a lot more qualified. That's sort of my, and we can get into how, I'll get into my view on my qualifications as opposed to just a blanket, hell yeah, we can all beat the markets if you work real hard and get in there and you develop an edge. And, but, I'll get into my qualifications on that. But I do still think at the end of the day, it's possible, but we should get back into defining what it means to beat the markets. What do we really mean by beating the markets? So I'll stop there, but I'd like to hear your thoughts.
I agree. It's hard. It's a lot harder than I thought it was when I was 22 years old buying my first stocks. I've made every mistake in the book, made some of them more than once, and in the end, I've come to having a lot of respect for the markets. But I now understand how they can be beat. It's less about intellect than it is about discipline. And there are different disciplines that you can take, and in the end it's all about sticking to a discipline, having the guts to stick to a discipline, and controlling your risks. Okay, so let's elaborate on that a little bit.
It's less about intellect, why do you say it's less about, there's some brilliant guys that we know are beating the market, like Jim Simons.
Sure.
Brilliant guy. He obviously is one of the cases that proves that you can beat the market. Now, I don't know if most people can have his level of intellect or IQ or however we measure those things. So there's that asset of that individual human's asset. Why do you bring in the realm of discipline, or why do you feel that that's a critical skill?
Because I've seen how simple it actually is in practice. I've seen how other people have beaten the markets with extremely simple practice, simple systems, and we together are developing systems that beat the markets reliably over the long term, and they are astoundingly simple. I would not have believed how simple they were years ago. What it comes down to is sticking to them. The markets are. Let's back up for a minute and talk about. Go back to Burton Malkiel. Burton Malkiel is probably one of the better known proponents of the efficient market hypothesis, which says that you can't beat the markets. It says you can't beat the markets in a specific way. It says you can't beat the markets by picking stocks. To go back to economics class, they told you that it meant that all information about a security was already out there and incorporated into its price. In the most strict definition, it was all public information and all private information was already integrated into the price. So there was nothing you could learn about that company that would cause it to go up or down. And I tend to agree with that view. With that view of taking a static view of the markets, it's very hard to. You can't drill down into a company's financials and find something that nobody else has seen. That's not how the markets are. That's not an inefficiency that can be exploited. I wouldn't play that game. People who play that game don't win by very much, if they win at all. On average, they underperform by a point or two a year. I think of it's better to think of beating the markets by overcoming irrationality, by staying cool, by exploiting the fact that the markets are not rational in a different way. When the markets go through manias and busts, the information doesn't change as much as prices change. What was the revenues of the S&P 500 fell by a few percent from 2007 to 2009. 4%, 5%, something like that. But the price fell in half. That's not rational. That's not efficient. That's the kind of inefficiency that can be beat.
So this is an interesting dichotomy at the philosophical level, to me, and I think is this notion of maintaining your cool, or what Buffett says, be greedy when others are fearful and fearful when others are greedy. And his framework is this concept that of Mr. Market, this business partner that's an irrational being, and every day you can either buy or sell stock against his irration and take advantage of his foibles. At the same time, I come out of a trading and markets background, and for better or for worse, I come out this concept that the market is always right, and you're the one that's wrong. And to go on with that line of thought is, you ever come across that book, Wisdom of Crowds, or the whole notion of the wisdom of crowds? The idea that a collective group of a large, diverse collective group of people are better predictor than any individual or any one genius. So how do you grapple around those two ideas, that we have the wisdom of crowds that exists, but then there's this irrational Mr. Market. Is the market irrational, or is he wise?
It's both. It's both. The market is rational in some ways and wise in others, and there are patterns. It's another point we can come back to, but the market doesn't move. It's not a random walk. It's not a random walk down Wall Street. And that can be proven mathematically. The random walk, the market stock charts, financial charts, are not random. There are patterns there. That could be. That's a proven fact. I
think that's what Jim Simons, who's at the forefront, is. I don't know. Proven. I'm not privy to what he actually does, but I do believe they do pattern recognition, or use pattern to develop some predictive.
He said that he exploits anomalies.
From a let's talk about this aspect. Is why is it important to beat the markets? So I'll tell you my way of looking at it is, when you're young and you're ambitious, you want to beat the markets because, like I said earlier, crudely, you're trying to get rich. Buffett said something really great, was that, I'm telling you all the ways to get rich, and Charlie and I are here telling you how to get rich. If you do exactly what we say, you'll get rich, but that's not good enough. You want it earlier. You want it faster. So you know, there's two parts. There's two parts to that. One part is that, you know, when you say can you beat the markets, you know, and when I was getting into my qualification of is it possible to beat the markets, I qualify it with this in saying that yes, I do think it's possible to beat the markets. I do think it's very difficult to beat it over time. But I would say, does that matter? If I can beat the markets and find an anomaly for 5 years or 6 years and exploit it, isn't that from a practical sense good enough? I mean, I don't.
As long as you don't give it all back.
As long as you don't give it all back. But you know, okay, so we have two. You know, we put two people. Put a person, who's a great trader today, put him against the markets, and we say eventually the markets wins out. But if he exploits an anomaly and has an early start and is making tremendous gains, the course of his or her life can change as a consequence of that. So it's worthy of. If you're ambitious, I think it's a worthy endeavor. The other thing is, even if you're not ambitious, but you're charged with being a steward of capital, or you're just a retiree, I think it's worth contemplating that question, because, you know, the simple answer when people ask you how do you beat the markets or how you should approach the market, not to keep coming back to Buffett, but he says, you know, he gives the answer that's the simplest and most effective answer. Like, how can anybody teach? You know, if somebody came to you and said, Ritger, teach me how to trade. It's difficult. How do you put together all that knowledge that you've accumulated, all the mistakes that you've accumulated, the wisdom that you've accumulated through error? How do you understand it yourself and then communicate it to somebody in an effective way? It's simpler to say dollar cost average, because that will work. Buy the S&P every month, put the same amount in, and you'll come out ahead. But this is the thing. That advice is good advice. We both come around, and I'd like to spend a little bit of time how I become a little bit of a convert.
I give that advice sometimes, because if I only have a minute, if I don't know the person well, I can help them just by saying that. If that helps prevent some terrible outcome, if all they do is buy an index fund and buy more when it's down, because I always emphasize, don't sell. If indexing is your game, if you are just going to buy and hold, you have to hold. And when it's down, you just keep buying. Treat it like a savings account. Don't try to beat it.
But so that's it's good advice if your earning is significant against your capital base.
Mm-hmm. It's good advice for a young guy. I'll give that without reservations to a young guy. I did just a couple days ago. A young guy I see in the gym sometimes asked me what to do with his Roth. I think he just opened it, just put in the $5,500, didn't know what to do with it.
So because they can earn their way out. But if you're a steward of capital, or you inherit a sum of money, or you're a retiree, I don't think you can approach markets as a passive investor. I think that advice has been academically rigorously proven, but I don't think it's sound advice for that person.
I'll take one exception with that. You can be completely passive as a retiree, as a very conservative person, if you diversify. I'm sure we'll get into this in further episodes, but if you break up your money, if you do the permanent portfolio, Harry Brown's permanent portfolio.
So that's the advice I give, the simplest advice I give. My cousin called me the other day. She was asking me what she should invest in. Now, she's made her money through the way most people make their money, through hard work, and she doesn't want to just gamble it away. And how do you know, so what advice do I give her? Because she cares about her capital base, I gave her the permanent portfolio, which is 25% of your money in S&P 500.
I can show you a much better one, by the way. I've refined it. You don't put a quarter in gold and a quarter in cash. You use more bonds, and you do some international stocks, and you put it a little bit in other commodities and some REITs, and then you just rebalance every year. But you set those, you're not trying to trade in and out of anything. All you're doing is rebalancing a truly diversified portfolio.
So let's talk about diversification. It took me a long time to appreciate the merits of diversification, because to me, keep going back to Buffett, but I went along the lines of diversification is for people that don't know what they're doing. This is, from our studies and what we've done, we've seen how it truly is the only free lunch on Wall Street.
Absolutely.
So you really can So this was a big epiphany for me. These two, one is, I thought I was really great. Not great's not the right word, but I thought I was really had the things that made for a good trade, meaning independent thinking, willing to go against the herd. When I got long with almost everything when I was 25 in the precious metals sector, and I took it from 2001 to 2000. And a lot of people that know me from trading know that, associate me with that sort of move. That I was, because in 2001 there weren't, at 25 years old there weren't a lot of people that were in that place. But this is the thing. When I look, my compounded return from 2001 to 2011 was very volatile, was very up and down. And when we compared it against one of the diversified strategies that we ran, we got the same return profile with tremendously less volatility.
None of the headache.
And none of the headache. That was amazing.
That's diversification. It costs you so little, if it costs you anything. Depending on the period you're holding in, to diversify, you might turn out ahead with far lower volatility. You don't necessarily, diversification can allow you to beat the markets if that means the S&P. The S&P is very easy to beat sometimes. Sometimes it's very hard to beat, like the last 8 years when it's compounded at 17% per year, which is, well, it's better than Buffett's done, and I think that's better than Buffett over the last 30 years. His lifetime compound.
It's like 13.
I think he's still about 19 lifetime, including the 50s.
Okay.
So when we're talking about compounded rates of return, this is something that people need to get a handle on. There are only a handful, and I mean like one hand, of guys who've had a whole career that's compounded at anything over 18%. You've got Buffett, you've got George Soros, I think he's the leader at 21. You've got Renaissance. They have different strategies, but some are very high. You've got some trend followers, futures traders, Bill Dunn, probably Jerry Parker. These guys are in the high teens, but with a lot of volatility. They've lost half their money more than once. That's the edge. You don't want to risk losing more than half because you can't take yourself out of that hole.
So this is the other thing that was an epiphany for me, was the way you're thinking about volatility. Since when you're focused on the upside, and if you say, well, I can get high returns, 20, whatever it is, some great returns, be up there with the Soroses of the world, and it takes volatility. As a young, ambitious person, I'm signing up.
Sure.
I'll do it.
Sure, it's rational as a young guy.
But this is what I didn't appreciate was, until we started doing our studies, is that there's a real financial benefit or mathematical benefit for volatility. It's not just what you can grin and bear. It's not, I thought of this idea was that, okay, I'm Rip Van Winkle, and if I can't take the up and down, I'm just a wimp, for lack of a better word. I'll go the up and down, but if at the end of 10 years it puts me way ahead of everybody in terms of performance, that's the road I should take. But what I didn't appreciate is that low volatility allows you to get the extra return through leverage. Meaning if there was two strategies and one got you 20%, but at times you had 50% drawdowns. Soros came close to losing his money a couple of times. I mean, I don't know, but he said, there's
this is a guy with strict risk control. He made his money really by controlling his risks, which is something that every great trader or investor does. Buffett doesn't buy crappy companies. That's his risk control. He doesn't pay too much. Futures traders, Soros types, they cut their losses. They make a lot of little trades. Most of them are losers. 60%, 70% are losers, but little losers.
That's right. That's that's one of the things when you read Market Wizards and you see all the traders. It's learn to love to lose.
Yeah. That was from the cotton trader who mentored Paul Tudor Jones in Louisiana.
That's right. So again, so we have a few lines of conversation on, but let's just stay with this for a while. I come out of a trading background. You also, and you're a product of, everyone's a product of what they've experienced and what they've seen. And as much as I respect Buffett's methodology, I don't have maybe the emotional makeup and the analytical ability to go down his road.
It's tedious and it's tough. He's lost half more than once, 2, 3 times, I don't know. But that's value. Value is things can get cheap and then cheaper by half.
And I don't have that conviction when the market's telling you that you lost. And I'll tell you one thing. I experiment with almost every kind of strategy. And this isn't this is what I found in the 2008 financial crisis. I was running multiple strategies, and one of my buckets was a fundamental based methodology. And at the time I was also with a fundamental based hedge fund that and I was starting to apply to U.S. stocks. And there was stuff that got cheap according to our fundamentals, and then the stock went from 20 to 15 to 10 to 5, and it's getting cheaper and cheaper. But then there's a management buyout. The management also found it cheap. Now that stock's off the exchange. So what are you supposed to do at that point?
It can happen.
It can happen.
But look at just the Dow of the entire market in the Great Depression. It fell by 60%, and then it fell by half. It was as cheap as it had ever been at 60%, and then it got cheaper. So even there, with diversification, sure, it was still a great time to buy in retrospect. If you held on for long enough to get that promised return, you came out ahead. But that's a gut-wrenching experience. There's the emotional aspect. There's to bring back to volatility. Volatility allows you to have reducing your volatility, controlling your volatility, gives you more certainty in your financial future. You kind of know where your money's going to be. If you invest this much a year and you average this much, such and such a return. If your portfolio is not swinging around by 50% this way and that, you kind of know, okay, in 3 years I should have 3 years is, you need more even with low. Say 5 years, in 10 years, I'll have about this much. I should be able to carve off a down payment for a house, pay for college, what have you. In my retirement over the next 20 years, I can have greater confidence that I can withdraw 3%, 4% a year, whatever it is to cover my expenses. If your plan is just buy the S&P, the price matters, the timing matters a lot, because there have been stretches in history where you've lost money for 10, 15 years, where you can get in a big hole if you just buy and hold stocks. Diversifying, every bit of diversification helps to reduce that volatility.
Okay, so let's talk about the before the diversification. You talked about it does matter to buying something expensive does affect your end return. It does matter. So one of the measures of macro value is the Shiller P or the CAPE.
Sure.
So I graduated college in '96, and the CAPE has been in the upper territory ever since my whole
stocks have been
career.
expensive. Our entire adult life, they got back to reasonable value at the bottom in '03 and the bottom in '07 and '09, but they didn't stay there long. So if I came in '96 and I was armed with all this historical knowledge and I said, well, stocks are expensive, I'm not going to participate, I'm going to wait for them to get cheap, I would have been out of the market for forever. You would have beaten the market, by the way.
So how?
Like if you just bought bonds when stocks got expensive, you skipped. Sure, you missed out. Stocks kept going up for a couple of years, then they crashed. Then they went back up to where they were, and then they crashed. And then it took them until 2012 to get back again to where they were in 1999, 2000.
Sure.
And now they finally kept shooting up. But you had 12 years where you went nowhere, not even adjusted for inflation.
But there were pockets of tremendous gains in that. Like the S&P didn't go anywhere, but 1996 to 2000 had the tech boom and bust.
Oh, by the way, so to complete the thought, if you had bought bonds instead in the late 90s, bonds were at a pretty good, 10-year was probably 5%, the 30-year maybe 6%, what it was. So you were chugging along at 5-6% all that time while stocks were going like this underneath you. You were just happy enough clipping your coupons.
So
that's a respectable compound return.
Well, it's more than clipping coupons because I didn't appreciate it. You're getting your 6%, but when 6% when the bond yield goes from 6% to 2%, there's a lot of capital appreciation in that.
Yeah.
Which I didn't appreciate then. But that's true. So you could have one could have played the markets and done well even by staying out of U.S. stocks since '96, right? You could have had the long bond. You could have played the commodities were relatively cheap. Global stocks were, I think, pretty cheap in '98 because of that long-term capital crisis and emerging, whatever, the Asian flu, whatever it was called, when Russia defaulted.
Sure, and you had a dollar bear market from the late '90s until the mid 2000s.
Right. I mean, now I don't know if people disagree on valuing gold, but if you use it as a relative measure against other assets, it was relatively cheap. So one could have played around.
Yeah, if you saw, oh, whoa, the U.S. is a bubble, I got to get out of stocks, what do I do though? You could buy bonds, or you could just diversify. Say, I don't know what's cheap and what's not, but I just know I don't want to be whole hog in this expensive stock market. And you just spread your money around different asset classes all around the globe. All you did was that. You rode out 2 bear markets.
Okay, so that's very true. Let's talk about that. So it goes back to what you said originally. Very early was what does it mean to beat the markets? So if we say the market is the stock market, well then it becomes easier to beat it because we do these tools of we diversify among asset classes. Maybe there was that study when you equal weight the S&P 500, that alone beats the S&P.
Yeah, by a couple percent a year, which over 15 years gives you twice as much money.
But what if we say, once somebody's privy to that knowledge, that I can do some diversification, and then our benchmark doesn't become just the S&P 500, but it becomes 60-40 or a better version of a more diversified portfolio. And we say, well, that becomes the benchmark. Is that valid? To say, well, that is truly the investment benchmark, and if we make that the benchmark, then how do you beat that?
That's an interesting question. Then you've got to be good. Diversifying is easy. Then you've got to know what you're doing. There's a lot of learning required to get good at beating a diversified portfolio. You've got to have good risk controls. You've got to know when to be in and when to be out, and how not to ever lose a lot at once.
So that's the premise behind the efficient market hypothesizers, if that's a word, is that it's impossible to know when to be in, when to be out.
You never know. You can just tilt the odds in your favor.
So do you know what Amarillo Slim was by any chance? He was a professional poker player.
It's a familiar name.
So, well, a name like Amarillo Slim, but he was a professional poker player, and he had 3 rules for how he approached the game, which was that you got to know the 60-40 end of a winning proposition. Mm-hmm. You got to know thyself, and you got to have risk management.
There you go.
And to me, it's become all about risk management. Who's a guy to me that should be better known. It's probably known amongst traders, is Ed Secoda.
Sure.
And I guess my timeline with investing, trading, was that we started as Nasdaq day traders, and the methodology was that look, you're an idiot, and
always a good place to start.
It truly is. Well,
it
truly is. So and that's why you're an idiot, and don't think you can outguess the market, and And what we did then was we followed the people, we followed the market makers that truly knew more about. In every single stock, we knew who we were trading against. So in every single stock, there was one market maker that really knew the stock better because he had the order flow or he was the underwriter for the stock. And we had to find out who, we called it the man. Who's the man in that stock and follow him. So if he's selling, you shouldn't be buying. And if he's buying, then you should be buying. So that being said, but we traded off the price. And I had I struggled in the beginning, but eventually I was able to, carve out a little bit of success. And with that success, you get, I guess, hubris, and you start thinking you know some stuff, and then you read some books, and you start thinking you know some more things, and you think, maybe I could be the next Soros. And then then macro investing, you start getting into macro investing, and then you start thinking you can beat the markets through analysis. That you can outthink the market, or you can outstudy the market, or you can find the hidden gem that nobody's uncovered. And then during this period of 2005 to 2014, I was a partner in a fundamental focused hedge fund. And from that process of starting as a day trader to go into a fundamental focused hedge fund, I really deviated from how I started, and my returns dropped. And going back to, I started with Ed Sakota, going back to the root of trading, which was he has something, I gotta look it up again, but he's got, it's simple. He goes, it's like, follow the, find the edge, which is a big thing. I don't think he says that, but he goes, make your trades, cut your losers, let your winners run, repeat the process. And when I got back to that, everything started improving again.
It's simple. You just have to stick to it.
Yeah, but I think it gets easier to stick to it as you get, as you see it working. Mm-hmm. That's the thing. I think people that are fundamental based or have the inclination to be more fundamentals based investors, they probably are more comfortable with that because that's how they've had success, or that's what they know.
It's intuitive. It makes sense.
It's intuitive. Now, being markets people, one of the things we find about markets is how much of it's counterintuitive. Mm-hmm. But then it goes back to one of the things I recall this, and I don't remember if I specifically read about this advice in Market Wizard or something, but was to find the style that suits your personality. And I don't know if your personality can grow into your style, or your style gets to mesh with your personality. But this is I guess digressing a little bit. But that to me is why me personally was always more comfortable with the trading. For whatever reason, I felt like it resonated more with me. But I think it's mostly because I feel like I have control of the risk. Yeah. I don't know if you have. This is an example, like the Valiant example of what happened in, I don't know if it was, has it already been a year or a year and a half, where a lot of the street was in the Valiant, it was a hedge fund darling stock. A lot of people got into the stock, and a lot of people got hurt by it, including one of these great investors. I think it was, I don't want to say the name because I don't want to mix him up for somebody else, but he had a tremendous track record, like a Buffett-esque track record, and he got caught in Valiant. And it ruined his whole long-term cater, and that would be the academic argument. See, I told you. Yeah. But that being said, I think that only happens with fundamental value guys. Like a trader would look at that and be like, "There's something wrong."
It keeps going down. I'm out.
Right. Whereas the fundamental guy keeps going back to his balance sheet, his financial statements, and is like, I don't get it. Like the market is missing something.
The trader is more humble.
Yeah, I think this is going to sound, I guess, counterintuitive, but I think it's very arrogant to be a fundamental-based investor, because you're saying that I know more than the market.
I think the only way to do it, the only way I would do it, is systematically. And the only way I like to do anything is systematically, whenever possible. It's just, it's
So let's talk about.
It's a lot easier on the emotions.
Well, let's talk about what do you mean by systematic?
By systematic trading or investing means you can write down your rules, every one of them. That you could hand over the rules to somebody else and they could trade exactly like you. They could execute it for you, or you could code it. And it's easier to say what the rules are simpler if you're talking about trading on price only, being a trader. But they don't have to be that complicated to do systematic value investing either. It turns out if you look at what Warren Buffett has been doing all these decades, well, he's doing exactly what he told us he's been doing. But what has he been doing? He's been running screens. Back in the 50s and 60s, he would get giant stacks of S&P reports and 10Ks, and he would just run screens for value, for price. He wanted companies trading at low multiples of price, earnings, of sales, earnings, and book, low cash flow multiples. And then he wanted quality. He'd make sure they didn't have too much debt, and that their earnings were steady or growing consistently. And there's this fudge factor, I guess, of you wanted to make sure they had a moat, a defensible business. But it turns out that you can code that whole process pretty much. You can just run those screens with stock screeners today, and they'll spit out the same kinds of stocks that Buffett has been buying. And yeah, they have beaten the market over the long term by a whole lot. They've been volatile. That portfolio will go down by half or more sometimes. But those stocks, it turns out, are systematically mispriced. There are human biases. There are crowd biases. It goes back to the madness of crowds. Well, crowds are mad in systematic ways. They're mad in consistent ways, and they could create anomalies that can be exploited.
So we could spend a long time talking about just Buffett, and we will one day. I have a question in this regard. Are you saying Buffett systematically found cheap stocks, and those stocks are systematically cheap, and because the market discovers their underpricing, they get the extra return? Or, my understanding was Buffett understood the power of compounding and found the companies that compound their book value, and that compounding effect generated the extra, the excess return.
I suppose that maybe there was a shift in Buffett's methodology a little bit in the 80s from looking for these massive corporations that had great management and compounded their money, managed their cash flow well, reinvested that cash flow productively. But he learned initially from Ben Graham, who was just looking at balance sheets. He was looking at price and balance sheets, and he wanted to buy assets cheap.
Right.
That's all Buffett did in the 50s and 60s when he had a 20-something compound return.
That's right.
And he kept that up. I mean, he's never left that behind. He added in quality. I think when he met Munger, they started looking because they couldn't find the super.
Well, they couldn't find. I think the market by '68, when he returned the money to his LPs, I think the market was generally not pricing. Didn't have that Ben Graham cheap stocks anymore.
But essentially, but then quality, the consistency of earnings, and the absence of risk in terms of debt it turned out, mispriced. Because if you just paid a fair price for a great company, that was good enough. That would compound at a really high rate, especially in the 70s when it was a cheap market.
Well, so I don't want to get too off topic, and let's see what we're doing for time. We've already been at it for 40 minutes.
Okay.
So maybe we can pick it up next time. But this will be, Buffett. We could spend, multiple episodes on.
It's not
Buffett.
even what we do. We don't even like it.
Which is what's great about him is he gives a framework. I don't know if it's a Japanese saying, but I think it's a Japanese saying is there's many roads lead to the same moon, or the American there's 100 ways to skin a cat.
More than one way to skin a cat.
More than one way to skin a cat, and And Buffett's got, figured out a way to skin a cat. And it's worthy. He's certainly worthy of study. A lot of people are disciples of his, and it's worthy of studying. What would also probably be interesting would be, spending more time on why we don't love that methodology. Maybe we touched upon it a little bit, but that's that might be worthy too. But there's going to be lots to talk about.
There's a lot to talk about.
See you next time.